Hi and welcome to Accountavision. In today's video we're going to learn what T accounts is and double entries by using only 4 steps. But before I get into the video, I suggest looking at my previous video where I go over debits and credits using the acronym called DEDCLIC, as I'll be using that in this tutorial. So a T account is an account that looks like a letter T, which represents different transactions. So it's going to look like this. We're going to have a debits on the left, a credits on the right, and we're going to have different descriptions of different accounts which will be put into here. So let's start by asking ourselves, why T accounts? Well, a T account is used to visualize different transactions. It is used to help prepare trial balance and financial statements. So let's see the steps. So step 1 is to identify the amount. Step 2 is to identify the accounts. Step 3 is to use the DEDCLIC acronym to determine which ones are debits and credits. And finally, prepare the T accounts. And by using all these 4, you'll be able to master double entries bookkeeping. Trust me. So let's see how it works. Well, you'll be given an example like this, which will have different accounts and different numbers, but all you need is these 4 steps, and if it helps, use the DEDCLIC. I say write this down because I'm going to be using that in this tutorial as well. So let's see how it works. Transaction 1 says they've invested £10,000 in the business, so using the 4 steps. Step 1 says to identify the amount, so we're going to use £10,000. Step 2 is to identify the accounts. Well, someone has invested in a business, that makes them part of the owners, so that's going to impact on the capital. And because they've put money in the business, it's going to increase the business funds, which will affect the bank. And step 3 is to use the DEDCLIC acronym. Well, we can see that C stands for capital, it's on the credit side, so we're going to write credit capital, which leaves us with a debit for bank. Now, step 4 is to prepare the T account. So we're going to write one account for bank and the other account for capital. So we're going to debit bank, which we're going to have to write a description here. Debit bank, let's say £10,000. And credit capital, which will be £10,000. And I'm going to write description here, where the figures come from. Next, they've sold £500 on credit. So using the 4 steps. Step 1 is to identify the amount. It's £5,000. I'm going to write that down here. Step 2 is to identify the accounts. Well, they sold on credit, so it's to do with sales. But it has nothing to do with bank because they sold on credit, which means that on the day they sold the goods to a customer, they do not receive the money because they probably offered them 30 days credit. So maybe after 30 days they'll receive the money. So we're going to write trade receivables, which is also known as customers. Step 3 is to use a DEDCLIC acronym. So we know that sales is an income, so we're going to write credit here, which leaves us with a debit for trade receivables because they're an asset. And step 4 is to prepare a T account. So we're going to have an account for sales and an account for trade receivables. So we're going to credit sales £5,000, write the description trade receivables, and debit trade receivables £5,000 and write sales. Next, they've received £2,000 from trade receivables. So it's 4 steps. Step 1 is to identify the amount is £2,000. Going to write that down here. Step 2 is identify the accounts. Well, they've given us a hint here. It's trade receivables. And because we received the £2,000, it's to do with bank. So receiving the money will increase that asset. And step 3 is to use a DEDCLIC acronym. So we know that receiving money is an asset. So we're going to debit bank, which leaves us with a credit trade receivables. And step 4 is to prepare the T account. So we're going to write one account for bank and the other account for trade receivables. So we're going to debit bank £2,000 and we're going to credit trade receivables £2,000. And it's important to write the description as always. So we're going to do that now. And next, they bought goods on credit. So we're using the 4 steps. Identify the amount is £4,000. So we're going to write that down here. Step 2 is to identify the accounts. Well, because we bought something on credit, it's going to affect the trade payables, which is known as supplier. And because we bought on credit, we haven't paid the money on that day we bought the goods. So we're going to write purchases account. So step 3 is to use the DEDCLIC acronym. So because trade payables or a supplier is a liability, we're going to write that as a credit, and which leaves us with a debit for purchases. And now we can prepare the T account. So we're going to have an account for trade payables and an account for purchases. So we're going to debit purchases £4,000 and credit trade receivables, trade payables I mean, £4,000. So we're going to write purchases here and we're going to write trade payables here. Next, they pay £500 for electricity. So using the 4 steps, identify the amount, it's £500. So we're going to write that down here. Step 2 is identify the accounts. Well, they've given us a hint here. It's electricity. So see, we're just going to write that down here. And it's also going to impact the bank, as even like whenever you see the word paid or bank transfer, bank checks and that, it's always going to relate to bank. So you're going to have an account for bank. So using the DEDCLIC acronym, you know that electricity is an expense, it's recorded on the debit, so we're going to debit electricity, which leaves us with a credit bank. And now we're going to prepare our T accounts. So I'm going to write E for electricity and an account for bank. So we're going to have to debit £500 for electricity and £500 for bank. So we're going to write a description here and a description there. Next, they've taken £6,000 for personal use. So we're going to write the 4 steps. Step 1 is identify the amount. We're going to put £6,000. Step 2 is identify the account. So because someone has taken money from the business banks, it's going to impact on the bank. And the other account will be drawings, as whenever you see for personal use, it's always an indication that it's drawings. Step 3 is to use the DEDCLIC acronym. So you can see that D stands for drawings on the debit side. So we're going to write debit drawings, which leaves us with a credit for bank. And now we can prepare the T account. So we're going to write a drawings account and we're going to write a bank account. So we're going to debit drawings £6,000 and we're going to credit bank £6,000, which is important to write a description. So we're going to write that and that. And finally, they borrowed a loan for £15,000 from a bank using the 4 steps. Step 1 is identify the amount, so it's £15,000. Step 2 is identify the account, so 1 is a loan. And because we received the loan, it's going to increase the funds, so it's going to impact on the bank account. Step 3 is to use a DEDCLIC, so we know that a loan is a liability, so we're going to credit that, which leaves us with a debit for bank. And now we can prepare the T account, so we're going to have an account for loan and an account for bank. So we're going to credit loan £15,000 and we're going to debit bank £15,000, and we're going to write description loan here and we're going to write a bank there. And once we've done all that, it should all look like this, where you'll be recording different transactions in different accounts. So before we go any further, it's important to note that anything relating to a balance sheets like assets, liabilities, and capital will always have a carried down and brought down. Let me explain why. So let's look at the trade receivables account. First, we're going to have to look which side has the highest number in total. We can see it's this figure here is £5,000, so we're going to write £5,000 here and £5,000 there. So let's say we made a sale of £5,000 on credit. We have 2 customers. One owes £2,000, the other owes £3,000. And let's say one paid £2,000, but the other hasn't paid yet in year 1. It will leave a balance of £3,000, which we're going to have to write down here, as which will go in the year 2 of a beginning balance of the next financial year. Why do we put £3,000? Because £2,000 plus £3,000 equals £5,000, and that customer has paid us the money, but this one hasn't, so they're gonna owe us money still in the next financial year. Okay, next is the income statement. Anything relating to the income statement will have the word IS, or you can write in full income statement. Like for example, for sales, we can see that it totals £5,000 and £5,000 here. But let's say we made a sale of £5,000 in year 1. We cannot say that in year 2 we made £5,000, which was from year 1, because that's irrelevant. It's supposed to be specifically from a specific year. So we're going to write income statement £5,000, because sales goes in the income statement. Okay, now let's do the other accounts. So let's look at the capital. We've got £10,000 here and £10,000 there. Because it's relating to the balance sheets, we're going to have to carry this forward to the year end and bring this forward to the beginning balance of the next financial year. So for bank, we've got this side's the highest, so we're going to write £27,000, £27,000 here. To get this side to equal £27,000, we're going to have to carry this down towards 20,500, which will be the end of year balance of year 1, which will then be the beginning balance of year 2. So for purchases, it's relating to the income statement. Why? Because it's a cost of goods sold. They are the goods that we are going to sell, which generates us revenue. Next is the trade payables. We've got £4,000 here, £4,000 there. We're going to have to carry this down to the year end, this year one, and bring this forward to the beginning balance of year two. Why? Because we still owe them money. We haven't paid anything yet to them. Okay, for electricity, we're going to have £500 here and £500 there. And because electricity is an expense, it goes in the income statement, so we're going to have to write that down here. Next is drawing, so we're going to write £6,000 and £6,000 here. And because this goes in the balance sheet, we're going to have to carry this forward to the next financial year. So we're going to write that down, £6,000. And finally for loan, we've got £15,000, £15,000 here. And we're going to carry this down to the next financial year, which will be the beginning balance of year two. And that's pretty much how you prepare and close the T accounts. But you may ask, what do I do next? Well, it depends on what the question is asking you, and they may just ask you just to prepare the T accounts, or it could ask you to prepare the trial balance, financial statements, or both. So it's important to read the questions carefully in order to get good marks on that. But let's say they ask us to prepare a trial balance. Well, we can use the dead click acronym to help us categorize which accounts go on which side. So let's say we want to know where the bank goes. We know that bank is an asset, it goes on the debit side, so we record that here on the debit side here. And let's say we want to know where sales goes. Well, sales is an income, it goes on the credit side, so we record sales, which will be here. And then once we've done all that for all the accounts, we should total both sides, and both sides should always equal. If they do not, then there may be mistakes you have made in the recording of different T accounts, and those mistakes have different concepts, which I'll explain in the later videos. And what if they ask us to prepare for financial statements, like for income statement or balance sheets? Well, they're most likely going to ask us to prepare a trial balance, but if not, we can still use the dead click acronym, and we can just prepare the income statement and balance sheet. So once we've done the income statement, we'll be calculating the net profit, which will then go to the balance sheets here. And once we've done all that, the assets should always equal the liabilities plus capital, which you can see here, this figure, which is total assets and the total liabilities and capital. But do not worry, I'll be going over this in the later videos in more detail. So just to summarize, apply the 4 steps. T accounts are used for financial statements and trial balance. It is important to read the questions carefully, and it's important to note that even if you made any mistakes, you will be getting more marks when doing your workings. So workings is very important. If you found this video useful, please like, subscribe, and comment down below if you have any question regarding this video or the videos you want me to go over in terms of like topics and that. I'll be happy to do that. So yeah, see you in the next video then.